with the latest on the corporate front, all the market trends, expert opinion, and sound business advice. It is your unique window into the business world, direct from the heart of China.
Hello and welcome to Biz Today. I'm Zhao Yang in Beijing. Coming up, we will have half an hour of business news and analysis. On today's show, China's industrial profits rose 3.6% from January to July. What was the private sector's role? And U.S. Federal Reserve Chair Jerome Powell signaled that an interest rate cut is imminent. But how quickly could the U.S. borrowing costs come down? And now let's begin with our top story. Data from China's National Bureau of Statistics shows that industrial profits grew by 3.6% from January to July. The Bureau attributed the improvement to strong performance in the high-tech manufacturing sector. The sector's profits grew almost 13%, contributing 60% to overall industrial profit growth. Meanwhile, the private sector industrial profits grew by 7.3% in the first 7 months. So for more on this, joined us on the line now are Chen Jiahe, Chief Investment Officer at Novem Archi Technologies, and also Yan Liang, Professor of Economics, Willamette University. So yeah, I will start with you. If you look at the data for the industrial profits overall, the industrial profits here in China rose at the faster pace, that is 3.6% in the first 7 months. And if you look at the number, the private sector, they saw a 7.3% growth. So based on this data, how do you see the development of the private economy in China?
Right. So I think that indicates that, coming out of COVID and also embarking on this industrial upgrading to continue to invest and profit from the high-tech sector, I think the private sector economy is doing well as far as, their industrial sector profit is concerned. So as you just mentioned, that these private sectors, their profit has gone up by 7.3%. And compared to the average is 3.6% in the industrial sector. And compared to state-owned enterprises, they're 1% growth, and foreign companies is 10% growth. So again, this just shows that the private sector has the advantage, right? They are more present in some of the high-tech sectors. When we look at companies like Huawei, Tencent, ByteDance, BYD, CATL, JD, Alibaba. So all of these are really, tech firms, tech companies in various sectors. And so I think that just shows that, when they have the technologies, when they continue to innovate, they're able to become more and more profitable. And I think that just indicates, on the one hand, that in terms of the macroeconomic environment, that the economy is now driven more by the high-tech, the tech sector. And on the other hand, I think that just shows that the private sector is really has the potential, right, to both become more and more innovative, but also become profitable at the same time. And I think that in some sense, it really debunks this myth, right, that in China, because of overcapacity, because of the cutthroat competition, industrial firms are simply unprofitable. And I think this number really shows that it's not the case.
Mm-hmm. So Jiahe, what do you think is the private sector's role in, China's economy, and especially in this, high-tech manufacturing sector?
Well, when we talk about the private economy in China, it's a critical important part of China's economy alongside the state-owned enterprises. Basically speaking, they employ a lot of people. I mean, if you look at the employment data, then private economy employs much more people compared with the state-owned economy. Today, much more Chinese people are working for private companies compared with the state-owned companies who are really concentrating in some more traditional sectors, for example, high-speed railroad, airport, petrol, banks, all these kind of things. But if you talk about sectors where they employ a huge amount of people, like tourism, restaurants, consumption, everywhere you have something like 90% or 95% with private economy. So employment is definitely one of the most important things for the private economy. The other thing what we talk about is innovation in high-tech sectors, because private economy are more dynamic compared with the state-owned companies. They stimulate people more. They give more bonus and shares. to whoever contributes a good idea. So that means in the high-tech sector, if you look at China's major high-tech companies like Alibaba, Tencent, JD.com, all these companies, also don't forget Huawei, all these companies, they are private-owned companies. And they actually won the competition in their own industries and businesses, and finally they won out from their competitors, and they became world-known high-tech companies. So private economy is definitely critical for the innovation of the China's economy in the high-tech sectors.
So China often says that the SOEs or state-owned enterprises are the backbone of the economy, but the private sector is equally important. So how do you understand that?
Right. So I think this is really one of the greatest strengths in the Chinese economy, in the sense that it's able to utilize the different forms of ownerships to have both the top-down, from the state-owned enterprises that carry out some policy directives and occupy some very important critical sectors in the upstream of the economy. So like energy, railway, telecommunication, finance, and all these key areas, I think the state-owned enterprises have really important role to play because they are not bounded by the short-term profit orientation. So it's very important for these SOEs to be able to carry out investments that are more strategic and also more long-term oriented. And these investments also create a lot of positive externalities for other industries, even though these companies may not make a lot of profits, but that really contribute greatly to the economy and the society. And on the other hand, we have the private enterprises, as we just mentioned. They're more nimble, they're more innovative, and they're also more profit-oriented, so they can really respond to the markets better. So I think, for China, this is great advantage that it's able to utilize, the state-owned enterprises in sectors, that are not really well-suited for private enterprises. But then at the same time, the government support, encourage, and also guide the private enterprises, to continue to reform, to innovate, to contribute to, the broader economy. So I think this is very important. And I also agree, when you look at the numbers, we often talked about, the 50, 60, 70, 80 rules, right? So we know that the private enterprises account for 50% of fixed asset investments, 60% of GDP, 70% of technological innovations, 80% of urban employment, and 90% of the numbers of the enterprises. So I think, both are critically important and indispensable. And I think for state-owned enterprises, even though they themselves may not be very profitable because of the kinds of sectors that they operate in, but I think they're really, really important. And that's why I think, based on the third plenum, this idea that we wanted to continue to reform the state-owned enterprises, and we want to come up with specific kinds of metrics to assess their performance, as opposed to just look at, what is the profit rate, what is the return on assets, what is the return on capital. I think those are very straitjacket measures.
So China will formulate a private sector promotion law. So why do we need such a law to further boost the private sector?
Right. I think that's a great question. I think, the reality is, China's economy, in terms of the market economy, right, has established in the 1980s. So we're still a very young market economy. So there's still a lot of areas, a lot of the, concerns, I think, facing private enterprises. So this law is meant to focus on the so-called core concerns of the private enterprises. And I think these laws are going to help to provide protection, guidance, but also assurance to the private enterprises. So I think, with this law and also with further affirmation that the government is going to support the private sector, I think this will really play an important role to assure private entrepreneurs to continue, to invest, to innovate, to really play their full potential in the Chinese economy.
So Jiahe, what's your understanding of this promotion law, and how important is it in terms of, further developing the private sector?
Well, when we look at the private sector, then China's government is keen on developing the private sector in the past 4 decades and more. We've got a huge amount of private economy coming up. And now this new promotion is keep on developing China's private economy, we have seen that the government has given a lot of support to the private companies from all sorts of ways. For example, the legal framework, the government policies and subsidies, the kind of industrial support, taxation relief, all these kind of things has been given to grow the private economy, especially in the past few years, because we have been got an economic hit during the COVID period, and then the property market came down. That's another challenge for the Chinese economy. So in this critical moment where the economy is facing multiple challenges from property sector and the turbulating global trading environment, then the government is putting a lot of efforts onto stimulating the private economy.
Mm-hmm. And China is now actually making efforts to strike a balance between different sectors, the private and public sectors. And Jiahe, so for foreign firms or multinational companies in China, their industrial profits we see growing nearly 10% so far this year. So what does this number tell us?
So if you look at the policies of the Chinese government, the Chinese government is keep on publishing on their websites and news medias. You can see that China is welcoming foreign investments at all times. It never stopped in the past 4 decades. So we keep on welcoming the foreign investment. And when the foreign investment comes into China, they get a huge market. 1.4 billion people. Think about how much that is. The US has something like 300 million. And the European Union got something like 400 million people. And China has like 1.4 billion people over here. And the consumers are capable, and they are having rising salary every year. Every year, our salary increased by about 5 to 6% in the past few years. So you've got a consumption market that is increasing larger and larger. And you've got a country that is much more stable compared with most of the economies around the world. Look at the homicide rate in China is one of the lowest in the world. It's comparable to countries like Singapore and Japan. So it's a really stable place. And you come here and you do investment, you make money. So that's what this data tells us.
Mm-hmm. And yeah, so overall, so what do you think are the kind of strength of China's economy, and what do they mean for multinationals?
So I agree with Jiahe. I think, China has many advantages, and we just talked about this very interesting dynamics, the equal important parts played by private enterprises and also state-owned enterprises. China has very huge market. Jiahe has elaborated that, right? I think 400 million strong middle class. That's tremendous amount of markets. China also has, over 200 mature industrial clusters. So that means even if you're not coming to China just for the market, many companies are also coming to China for that efficiency gain, right? So where else can you find the kinds of productivity, the kinds of infrastructure to be able to mass produce the products for the world's market? So I think both for efficiency seeking and for market seeking multinational corporations, they cannot afford to miss out China. And I think one more thing that we haven't talked very much about that becomes very increasingly attractive is China's technological capability. I think nowadays there has some kind of switch roles. China used to be a student, right, that learns the technologies from foreign companies. And I think in some sectors now that role has reversed. So like EV, in some of the clean tech industries, we're actually seeing China is able to provide the key technologies. And so I think that is also one of the reasons when you look at companies in Germany, like BMW, Audi, and Volkswagen, they have been coming to China and set up joint ventures here, not only because they're able to produce here, but also they're setting a lot of innovation hubs, R&D centers to really trying to learn from China's advanced technologies in EVs, batteries, and other sectors. So I think that's why China remains really important, not only as a market, also as a world factory, but now increasingly as an innovative hub. So that's why I think this is going to be the new trend.
So, what's the view of the U.S. investors about the opportunities in China? For example, if we take a look at the number of FDI from U.S. to China, the number in the year 2021 and in the year 2023 actually is growing. If you also take a look at some of the M-China survey, 90% of the U.S. foreign invested companies in China are profitable. So what does all this number tell us?
Yes, I think that's a great point. And that's exactly what I wanted to point out. When you look at the US foreign direct investment, it has been increasing. The number that I got in 2022, they have about $126 billion of FDI stock in China, which is a 9% increase from the year before. And according to AmCham, which you just mentioned, they just had a recent survey in the end of 2023 with over 340 respondents. 49% of the respondents, they anticipate to be profitable in the year to come, which is higher than the previous year's survey. And 50% of the survey participants now rank China as the top choice or within the first 3 top investment destinations globally, which is again 5% increase from the year before. And we also just learned, companies like Apple, they just invested $1 billion or plan to invest $1 billion, not only to produce more iPhone, because they're seeing China as an important production site for their iPhone 16's launch, but they're also, invest in Zhengzhou, some of the R&D center, innovation center. So I think that just goes to say that I don't think the U.S. investors are any different than some of the European investors. They still want to come to China and do business here. Now, of course, that is against the backdrop of the U.S. Government has been preaching the de-risking strategies and ask companies to in a way not just do business in China, but also elsewhere. But I think the businesses are still voting by foot, right? They will definitely continue to see China as an important partner, as important market, an important innovation hub. At the same time, they may set up some supply chains elsewhere, right? The very famous China's plus one strategy. But it doesn't mean that they're going to scale back the investments in China. All it means is that they probably have to grow their pie bigger, that they not only invest in China, but elsewhere. But still, I think, when you look around, both in terms of a global supply chain, in terms of market, in terms of innovation capabilities, I don't think any firms can miss out on China, despite these kind of political pressures.
Well, we're speaking with Yan Liang, Professor of Economics, Willamette University, and also Chen Jiahe, Chief Investment Officer at Novum Archi Technologies. And after a short break, U.S. Federal Reserve Chairman Jerome Powell signaled that an interest rate cut is imminent. Stay with us.
I am Dan Wang, Chief Economist of Hang Seng Bank, China. The World Today is a real fun program. You will hear interesting people discussing global trend, economic event, what's happening in and outside of China. So, friends around the world, hope you can join us.
You're listening to Biz Today. I'm Zhao Yang in Beijing. U.S. Federal Reserve Chairman Jerome Powell delivered a keynote address at Jackson Hole Symposium. He signaled that an interest rate cut is imminent as the inflation risk eases.
Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust.
He didn't say if the cut would occur at the next Federal Reserve meeting in September or to what extent. So yeah, actually, U.S. Federal Reserve Chairman Jerome Powell said that the time has come for policy to adjust. What is the signal to the market?
Right. I think he specifically mentioned the upside risks of inflation have diminished and the downside risks to unemployment have increased. And, he talked about the FOMC has a dual mandate, which is, maintain price stability, but also minimize unemployment. So that is very clear signal to the market. And as you just mentioned in the quote, that it's time for policy to adjust. So I think the market has already priced in the expectation that the Fed is going to cut rates as early as September, defying some of the long tradition that the Fed is not supposed to change the rates before the election, not to kind of risk this kinds of political ramifications of that. But I think all signs point to the fact that I think the Fed is going to start cutting rates as early as September. I think now the big question is how much is the rate cut? Is it just 25 basis points, or is it going to be 50%, 50 basis points? I think that still remains unknown, and I think that still depends on what the numbers look like in August. We know now the unemployment rate has gone up to 4.3%. We also know there has been a major revision in terms of the job created in the from March 2023 to March 2024. The BLS has revised down 818,000 jobs. So the labor market wasn't as tight or overheated as previously believed. At the same time, the inflation rate right now is measured by the PCE is, the Fed's favorite measure is, I think, 2.4%. It's still higher than their 2% of target. But I think for them, this has been a sustainable kind of path drifting down. So I think they will go ahead and cut rates. Again, the question remains, how much is the cut? I think that is still unknown at this point.
So, Jiahe, so what do you think is the signal, and what does it mean for the international capital flow?
Well, basically speaking, I think everyone around the global market are expecting that the Fed will cut the rate. So, because if you look at the inflation, it's now pretty much under control, still staying at about 3%, somewhere around that. It's not really low. I mean, if you look at China's inflation, it's like below 1%, and in most of the economic theories, people say you should stay around 1 to 2%. So 3% is slightly high, but it's still, it's under control. So it's not hyperinflation or high inflation. That's one thing. And the second is that the unemployment figure in the US is now gradually picking up. So that's a very bad sign, which shows that if you keep on putting an interest rate at a very high level, then you probably will have a weak economy in the coming year. And that means if the economy is turning downward and the production is not enough for the consumption, you might trigger another round of inflation. And at that time, what you will face is that you have a weak economy and you have a high interest rate, and you have to keep on rising interest rate in order to bring down inflation. That's something that the Fed can't take. And so what they must do at this moment is, I think it's cutting the interest rate at this moment. So it's basically, as what Yan has just said, it's a matter of how much. Is it 25 basic points or is it 50? But I think maybe it will be a pretty large extent because they don't have much time, because if they cut it too slowly, then it's probably similar to the fact that you're not cutting at all. I mean, cutting like just the 25 basis points it's not really enough. So currently in the global stock market is that people are expecting that, and capital are trying to run away from assets that are basing on the high interest rate, for example, bonds, especially long-term bonds, but they're trying to flow to the equity markets. And because we are basically investing in China's markets like Shanghai, Shenzhen, Hong Kong, and probably we will have money inflow from the global capital when the overall interest rate is cut in both the US and EU.
And yeah, so the U.S. interest rate cut may ease some concerns, but what do you think are some of the more deep-rooted structural problems for the U.S. economy?
Right. So I think the rate cuts, I think it would have positive and in some ways negative impacts on the U.S. economy. So for some of the, I think ironically negative impacts is that we know that once interest rate goes down and there could be, more housing demands. But because the housing supply is very slow to adjust, so you could easily see how the housing prices could go up, and because housing price really has a very significant role in terms of, for example, CPI. Housing market accounts for about 33% of the CPI basket. So we could potentially see that inflation ratchets up again once that rate cuts really materialize, and that feeds into the housing market. The other, I think, some of the unexpected negative consequence of rate cuts is that, as we know right now, the federal government is paying interest income to treasury holders. So once you cut the rates, that interest income that is injected into the market, in the economy, will be reduced. And so that could in some ways take away some of these fiscal stimulus effects to the economy. On the other hand, I think rate cuts will be very helpful as households have been ramping up, credit card debt, and also some of the long-term investments, especially green investments, may be disincentivized because of the high rate. So I think that in that sense, rate cuts will be beneficial for the U.S. economy. And it's definitely helpful for the rest of the world. As we know, countries like Japan is very hesitant to keep the rates unchanged because of this large interest rate differentials and the carriage rate in many ways would depreciate the Japanese currency. And that really makes their policy autonomy diminish. Same with the ECB, even though the ECB, because of their economy, was really not very positive. They have already started cut rates before the US. But I think, the ECB bankers are still really worried if the US hold up the interest rates and they keep cutting, that's going to also create some unintended consequences for the currency values, capital outflows, and so on and so forth. Not to mention, I think for developing countries, if the interest rate is cut by the Fed, this is going to help them, both in terms of their currency will depreciate less against the dollars, also means that their external debt denominated in the dollar, paying the interest rate set by the Fed or anchored by the US Fed interest rates, they will see some reduction in their external debt burden. So I think overall, the Fed cutting the interest rate is probably good news for the world economy, but it does come with some downside risks.
Well, we're speaking with Yan Liang, Professor of Economics, Willamette University, and also Chen Jiahe, Chief Investment Officer at Novum Archi Technologies. And that's all the time we have for this edition of Biz Today. I'm Zhao Yang in Beijing. Thank you so much for listening.